You wait, you watch, and you finally pull the trigger on a strong trend. Then, the exact moment you enter your position, the momentum collapses. To avoid buying right at the top or selling at the absolute bottom, traders typically pull up standard momentum indicators like the RSI or the MACD to warn them when a trend is dying. Those tools are incredibly popular, but they share a core mechanical flaw. Their math relies almost entirely on historical closing prices. Because they average out those closing prices over time, they naturally lag behind live market action. When the market gets choppy, that lag generates false signals, baiting traders into terrible entries. Legendary technical analyst Thomas DeMarker engineered a way around this problem by throwing the closing price out the window entirely. He built an oscillator called the DeMarker indicator. Instead of looking at where a candle closes, the DeMarker focuses strictly on the extreme edges of the action, the absolute highest and lowest prices reached during a specific period. A closing price often masks the true pain felt in the market. By analyzing pure price extremes, we can isolate the exact mathematical breaking points of buyers and sellers. Picture a currency pair pushing steadily higher in a clean, undeniable bullish trend. Looking at this chart, the DeMarker calculates demand by taking the absolute highest peak and lowest valley of one period and comparing them directly to the peak and valley of the previous period. It typically uses a 14-period lookback, plotting the results on a scale from 0 to 1. This chart shows how the math behaves in motion. Notice how the indicator stays anchored firmly above the 0.50 midline. As long as it holds that ground, you have confirmation that the bullish momentum is real. Then the clean run stops and the price starts tearing back and forth in a tight sideways range. When you drop a standard closing price indicator onto this mess, it zigzags and issues false sell signals. But look at the DeMarker in the middle. It stays perfectly, stubbornly flat. This stability comes from tracking inter-period volatility. That is the measure of price expansion between one period and the next. Because the absolute highs and lows of this choppy range aren't expanding, the DeMarker registers no actual change in demand. Where other indicators get tricked by the surface-level noise of a flat market, the DeMarker ignores the chop by demanding proof that the boundaries of volatility have actually shifted. Eventually, the pair breaks out of that sideways chop with one aggressive spike upward. On this chart, that sudden surge pushes the DeMarker straight through its upper limit, crossing the 0.70 threshold. Anything above 0.70 is considered overbought, meaning buying demand is mathematically maxed out. The exact inverse happens down at 0.30, marking oversold conditions, where the sellers are exhausted. You don't sell the exact second the line hits the red zone. You wait for the hook. Watch as the indicator crosses back below the 0.70 line. That downward hook is your mathematical confirmation that buyers have lost control. There is an even stronger signal called divergence. Here, the actual price makes a new, higher peak, but the DeMarker creates a lower peak. The price and the underlying momentum are directly contradicting each other. Catching a reversal is never about guessing the absolute top. It is about waiting for divergence and hooks to prove the buying pressure is dead. Spotting these hidden exhaustion points allows you to enter a correcting market precisely as the broader crowd gets trapped in bad positions. But technical analysis is not magic. Operating purely off a single oscillator without looking at the bigger picture is a fast track to liquidated accounts. Look at this relentless upward trend. When major economic news drives the market, prices can stay pinned in the overbought zone for days or weeks. Anyone shorting the market here just because a line crossed 0.70 will be destroyed. The DeMarker must be paired with established support and resistance zones, an awareness of the daily news cycle, and strict stop losses. Surviving the currency markets requires building a cohesive system of risk management, rather than hunting for a flawless indicator that doesn't exist. Consistency comes from trusting your logic when the charts get chaotic. Open up your trading terminal today, apply the DeMarker to your favorite currency pair, and start looking for the true